Guys, a lot of people are looking for income investments that pay high quarterly or yearly or monthly rates. And so a lot of them get enticed into closed end funds or CEFs. And if you look at something like an ETF of the utility index like XLU, it yields about 3% a year, while another CEF utility fund yields like 8.3% a year. How is that possible? Are they just so much better at picking utility stocks, or is there something more to that? So in this video, I'm going to explain very clearly the difference between ETFs and CEFs using graphics so you can understand it very easily. And I'm going to show you that those CEFs that show their distributions, those are not all dividends. There are a lot of things that can contribute to what they pay out. And in some cases, it could be kind of like a reverse mortgage on your house, where basically you give the bank your house and they give you some money back every month until something happens, you die, or they give you a certain amount or something like that. So let's get into it. Now, normally ETFs just hold either stocks or bonds. They don't have a mixture of them usually, whereas closed-end funds, they could hold some stocks, they could hold some bonds, they could hold some preferred stocks, they could hold all kinds of stuff. But I'm going to keep things very simple here. So instead of having these two different boxes with a bunch of different stocks, we're going to just have each box hold just one stock, Microsoft. So let's say each of these boxes hold 1 million shares of Microsoft each, and the price of Microsoft at the time is $100, and so the price of the ETF is $100 and the price of the CEF is $100. Now, in an ETF, the amount of shares outstanding is always changing, where in a CEF, it is not, unless they do a capital raise to take more capital in. But let's just say this doesn't change, the amount of shares in this CEF doesn't change, but the ETF shares can change, and I'll show you how. So let's say the stock price of Microsoft goes up to $105, but the ETF price is still $100 and the CEF price is also still $100. That means that this Microsoft stock that could be bought for $100 is really worth $105. So there's an arbitrage opportunity here. So a hedge fund or a big institution, they can buy out some of the stock from an ETF if they do it in big chunks, like maybe 10,000 shares or something like that. But in this case, this hedge fund guy would go to the ETF and say, look, here's $100, right? I'll give you $100 because that's the ETF price, and you give me a share of Microsoft, right? And he takes this Microsoft that he paid $100 for and now sells it in the open market for $105, and so he makes $5. Now, normally the discrepancy probably won't even get that big, and so enough people will keep doing that so that the price of Microsoft stock will either go down a little bit and the ETF price will go up a little bit until there's no more arbitrage. So the ETF is basically a way that it keeps the net asset values of what's in the box equal to what the current market price is of all these stocks that are in that box. So there's no big discount or premiums in normal times on ETFs. With CEFs, that is very different. There could be premiums or discounts for months on end or years on end. And that's because when a CEF starts, they do an initial public offering. And so let's say they have 1 million shares of Microsoft, they sell 1 million shares of the CEF. So let's say a whole bunch of normal, regular people own shares in the CEF, and the stock price of Microsoft is 105. They can't do like the hedge fund guy did with the ETF. They could buy CEF stock on the open market, but if nobody's selling or the selling price is a lot higher than Microsoft price or something like that, or it could be even lower than Microsoft's current price. So this price, even though it's $100 and Microsoft price is $105, it is trading at a $5 discount, right? But there's nothing to say that there may be no buyers and somebody tries to sell this thing and it goes down to 98 or 97, or there's a whole bunch of buyers and this thing could go up to 105, 110, even though the stock of Microsoft has not moved. So the price of the CEF changes based on people buying and selling. There is no stock coming out of this box to any institutions or anything like that. The amount of stock in here stays the same. Now, this is kind of a good thing for the CEF because a lot of times these CEFs hold things that are very illiquid, like some obscure bonds or thinly traded bonds or something like that, where if the market had turmoil and people wanted to get out and they had to sell these things on the open market, they would get a much lower price because it was kind of a fire sale. And so they don't want that to happen. So they say, look, if you panic and you want to get out, you're going to have to sell to somebody else who's willing to buy. It's not going to mess up anything that's in our box. And so because of that, these things often trade at a premium or a discount to all the things that are in this box. Now that's good if you could buy this thing at a discount to the net asset value, meaning all the stock that's in this box. If the Microsoft stock is at 100 and you can buy this CEF for 98 or 95, you're getting, say, a 5% discount. In some cases, some of these things can have huge discounts. And the most famous example is the Grayscale Bitcoin Trust. And so the Grayscale closed-end fund, GBTC, it shows the market price, meaning the price you can buy this CEF for, and the net asset value, meaning how many Bitcoins were in that box and what were they worth. And in the 2020s, this thing was selling for a lot more than the Bitcoins in the box. You see, market price was 27, the net asset value was 7. But then that flipped around 2021 when the market price was $32, but the Bitcoins in the box were worth $45. And that discrepancy is based on a lot of things, but because you couldn't get those Bitcoins out of the box like you can with an ETF. So while the fixed amount of CEF out there is a good thing for the fund, it could be a bad thing if you're buying it above the net asset value, but it could be a very good thing if you're buying it below the net asset value. As I said, some of them trade below sometimes for some reasons or others. And if you go look at a chart of some of these and look at maybe in the global financial crisis 2009, some of these things traded way under the value of the stocks or securities that were in their box. And so if you were buying back then, you could have gotten a 20-30% discount in some cases to the amount of securities, the market price of the securities that were in the box. So now here's the question. If these things both hold the same basic stocks, say like on the utility index, which I'm going to show you, then how do these CEFs have such high dividend payouts or distributions, as they're called, compared to a very similar ETF? Well, for number one, the CEFs in many cases use leverage, and in some cases up to 20, 30, 40, 50% leverage or something like that. So that's part of the equation there. And the other part is that the payouts that they give you are not just the dividends that the securities they're holding are paying out. Okay, so let's see how the payouts or the distributions, whatever you want to call it, the difference between an ETF and a CEF with the same exact stock in their fund, right? So let's say you held both of these for a year and 1 day, and on the last day of that year and 1 day, the Microsoft stock price is $112, but $2 of that is a dividend, right? Because Microsoft, let's say they pay a 2% a year dividend, and it gets paid on that last day of the year, let's say, right? So Microsoft is just about to pay out this $2 dividend. So that $2 is included in the Microsoft price. When they pay out this $2 dividend, the stock price should drop down by $2. It usually does. So let's see what happens. Microsoft pays out the $2 dividend to the ETF holders, right? So they get $2. The Microsoft stock price drops down to 110, and the ETF stock price drops down to 110. So basically, they have $110 in net asset value here, plus they have $2 here. So what is their yearly gain? Well, all in, it's 12%. But dividend-wise, it's only 2%, and they have a long-term capital gain of $10 that they could sell if they want to or not and just hold on to it. And of course, if they don't sell, then this gets compounded if Microsoft goes up in the next year. So they're not selling any stock to cash out at all, just take the $2 in dividend. Now let's look at the CEF. So same thing with the CEF. Microsoft pays out that $2. They take the $2 and give it to their CEF holders, right? And therefore, the CEF price should drop to 110 if there's no discount or premium on the CEF price, but there could be, but let's just say there isn't, right? So right now they got $110 and $2, same as these guys. However, these guys say, look, we want, high yearly distributions. So the CEF goes, yeah, I know that. That's why I'm selling some Microsoft stock. I'm selling $10 worth, and I'm giving it over to you guys so that you look in your bank account and you go, look, these guys gave me $12 distribution on this CEF, right? But the price is going to have to drop down too because the net asset value is now only $100, right? So what do they get? They get a CEF with the price of $100, plus they get $12 here. It's the same exact thing that they have here, except these people are going, no, we're getting 12% dividend on our money right here. And what they don't realize probably is they got really like $99 in net asset value because this fund takes 1% a year just to manage this fund. So they're actually worse off than the ETF people that only got a so-called 2% dividend but didn't have to sell any of their stock. So this is how the same exact Microsoft stock in a box of ETFs and a box of CEFs, right, pay out the same exact amount of money, but these people think they got a 12% dividend and these people only got a 2% dividend. So this is the fallacy of the high distribution that you get with the CEF. There is no magic here. The only magic, like I said, is if this fund uses leverage, and let's say they used 50% leverage to buy another $50 worth of Microsoft, then yes, the return will be another $6 higher, let's say, something like that. In that case, then yes, there is a difference. But like I said, with higher interest rates, that would be the hurdle rate to pass what their borrowing percentage rate is. So with higher interest rates, this may not always be positive in taking leverage to buy more Microsoft stock or whatever investments they have in this box. But if you're just looking at it apples to apples, you own the same Microsoft stock, you're getting the same money whether you just take out the dividend and keep the gain from the year, the long-term capital gain, you keep it going, or in this case, they pay it out by selling some stock and giving it to you and calling it a 12% distribution and taking their dollar every year for doing that. So remember, there is no free lunch. So if you look at one of the biggest utility ETFs, XLU, you see they have about $14 billion in assets, but their yield is only like 3%. But here you got the Reeves Utility Income Fund, UTG, which is a closed-end fund, and their yield is 8.37%, and they have about a $2 billion market cap. How is this possible? So let's look at some data from the UTG Utility Fund. Right, monthly distribution, 19 cents. Market price $28, net asset value $27.87. So there's $27.87 worth of securities in the box, but the stock price, if you want to buy it on the stock market, is $28.25. So it's trading at a premium of 1.36%. Not terrible. And you see their total returns, 10-year 6.59 since inception, 8.8%, which is from 2004. Now, what are the brilliant stocks in here that they more than double the XLU dividend? Let's see. Deutsche Telekom, pretty boring. Constellation Energy, PPL, Comcast, CMS Energy, Entergy, NiSource, TELUS. All of these do not have dividends anywhere close to 8%. So even if you look at their full holdings, you'll see Duke Energy, this is, I believe, under 4%, Edison International, Norfolk Southern. I mean, none of these have anywhere close. Southern Company is like 4%. So where are they getting this 8%? All right, Verizon has like a 7% dividend, but it's only 1.8% of the fund. Okay, so let's see this fact sheet. Objective to provide high level of after-tax total return consisting primarily of tax-advantaged dividend income and capital appreciation. It intends to invest at least 80% of its total assets in dividend-paying common and preferred stocks and debt instruments of companies within the utility industry. Up to 20% of the fund may be invested in securities of other industries. Right? Since inception, they distributed $1.3 billion to shareholders, but have a look at this. Qualified dividends in blue, non-qualified dividends in gray, and long-term capital gains in red. And so you see when they started 2004, 100% of their payout was qualified dividends. Now, qualified dividends get preferred tax treatment, the 15% rate. Non-qualified dividends do not get that. It gets taxed at the rate of whatever your tax bracket is. And long-term capital gains also generally get taxed at the 15% rate for most people. Unless you're a really high earner, then it's like 20%. So, but what this chart is saying that although it started out paying only the qualified dividends, now the qualified dividends that it's throwing off does not equal that 8%. The rest of it comes from them having to sell the positions in this CEF to realize long-term capital gains. Now that works if the utility stocks and the stocks that it owns keep going up. But if they don't, like look at 2022, the majority of the payout was long-term capital gains. So if there are no long-term capital gains, then the payout is either going to have to get cut, or what some CEFs do is actually just sell some of the securities and give you short-term capital gains, which you get taxed at your regular tax bracket. And so if your CEF is paying out the interest income or dividend income plus capital gains, and that's still not enough to cover what they actually pay you, and so they're giving you return of capital, meaning they're selling some of the stock in there, they have to have this Section 19A notice. So here it says the fund estimates that it has distributed more than its income and net realized capital gains. Therefore, a portion of your distribution may be a return of capital. So a return of capital, for example, may occur when some or all of the money that you invested in the fund is paid back to you. A return of capital distribution does not necessarily reflect the fund's investment performance and should not be confused with yield or income. So you see their current distribution, the net investment income was almost 5 cents a share, which is about 25%, almost 26% of what they paid out. The net realized long-term capital gain was about 14 cents or about 74% of what they paid out in a distribution. They may not always have these net realized long-term capital gains, and that's a huge portion of your distribution. But looking at the fiscal year-to-date cumulative, you see net investment income, 24%, realized long-term capital gains, 72%. But return of capital or other capital source, 3.4%. So they had to sell some of the positions to actually pay you your distribution. And if you look at their 2023 annual report, you see that they had $520 million in leverage, or about 27.5% of the fund. Now, the leverage may work when you're borrowing at 2 or 3% and getting dividends of 5%, but they don't work so good when you have to borrow at maybe 5.5%, 6%, and the dividends are still paying like 4%. That is upside down. So higher interest rates are not good for this fund's distributions. And so looking at the growth of $10,000 invested in 2013 of this fund, you'll see that the market price is about 18,700, but that still doesn't beat this gray line of the S&P 500 Utilities Index, which would be 21,700 approximately. Now, here's a breakdown of the investments they have. And like I said, it's very similar to what might be in XLU, something like that. Where it differs is down here: corporate bonds, limited partnerships, preferred stocks, things like that. These are a lot harder to get in and out of, so that's why they are better in a CEF type vehicle than an ETF. And it's very strange that their fees are not listed on their main page. You have to look in the yearly report. And so here you see investment advisory fees, 0.72, interest payments on borrowed funds, 1.38, total annual fund operating expenses, 2.33. Now, if you take out the interest that they pay on the leveraged part of the portfolio, the fees are about 0.9%, which is about 10 times higher than the fees for XLU. So looking at the utilities ETF XLU, you see the gross expense ratio is 0.09, or about 10 times less than that CEF UTG. Right? It just holds 31 holdings, 30-day SEC yield 3.12. And this is the graph of the premium and discount to NAV. As you see, it's always very, very low. I mean, it doesn't really get out of whack much. And here's the thing. According to the benchmark, the 10-year benchmark is 9.14. The NAV and the market value of the XLU ETF is 8.99. So this 10-year return is actually better than the CEF, and its return since 1998 is 7.34. The only difference is you're only getting like 3% a year in dividends, but you're getting the appreciation of the XLU. Whether you choose to sell it during the year or not is up to you. Whereas with the CEF, it's like you're getting that same little bit of dividend, but then they sell the stocks to get a capital gains to make it look like you're having a bigger distribution than you really are. And so the top holdings are the usual suspects: NextEra, Southern Company, Duke, Constellation, Dominion, PG&E, Exelon. So very similar holdings, I would say, to the UTG CEF, except for there's no bonds involved. And of course, no leverage. So guys, there's nothing new under the sun, and there is no free lunch. People are excited by these headline distribution numbers, but in reality, all they are is lumping the capital gains and even sometimes return of capital if the stocks are not doing good in their fund, and making it look like they're giving you back all this money, compared to a fund that is just strictly dividends and giving you this small dividend. And you compare the two and you go, why should I buy this 3% dividend thing when I could buy this 8% dividend thing? Now, I see some people comment on some YouTube videos about this and say, well, I like this 8% dividend because I get a steady paycheck every month or every quarter or whatever, and so I get the cash flow and I'm happy with that. But you're paying almost 1% a year to do that, which you could do yourself. So you could just buy that XLU and get 3% worth of dividends every year, and then sell some of the XLU stock to get that other, say, 5% to equalize it to what UTG is paying out. There's no real difference there. There may be a little difference because of the leverage, but like I said, with interest rates what they are, they're probably borrowing at a much higher rate than they were a year or two ago. And so they may not be employing that leverage because it may be getting them a negative return. If these stocks aren't going up and they're just getting the dividend from it, it may not work out. Now, this doesn't just go for utility stocks, it also goes for these CEF bond funds. Like PIMCO is having problems with PDI and PTY, the same type of problems. And so some of the stuff that they're paying out is actually return of capital, or they're doing some kind of swaps and some really complicated stuff to keep that payout going. I don't know how long they can keep that up, to tell you the truth. So if you want to save yourself some money, you could just buy these stocks individually and get the income from the dividends, which are qualified dividends, the low tax rate. And then you can sell off some stock after you own it for a year, so you get long-term capital gains to make up the difference of the kind of return you're shooting for, 8-10% a year or something like that. Or if you like the idea of getting a certain return of cash to you every year, you could just go buy something like Berkshire Hathaway stock that owns a whole lot of dividend paying stocks, even though Berkshire Hathaway doesn't pay dividends themselves. And so you could just hold that stock, and as long as you hold it for longer than a year, you could sell off what you need every year, say 8-10% of whatever you're thinking you want to get, and it'll be a long-term capital gain at the lower rate. And you can even set it up to automatically be done for you in Schwab or Vanguard or Fidelity or something like that. So the argument that I want it done automatically and I'm going to pay these CEFs 1% to do that for me, you can set it up yourself. Once you set it up, it will do that every year or whenever you want, 3 times a year, 4 times every month or whatever. So looking into these CEFs, what do I think of them? I think they're kind of overpriced for what you get. Maybe in times when the leverage will help, they may be okay. Or in times of big stresses in the market, you may be able to pick up some of these at big discounts to the net asset value, to the assets that it's holding. At that point, I would say that would be a good time to look at picking some of these up. But I would not be buying these if they are trading for higher than the net asset value. And there are some that are trading, I don't know, 10-20% or more over the assets that they hold. Why would you do that? I have no idea. I personally would not. So know what you're getting into when you're considering buying these things, and don't just look at the headline number that says you're getting this fat distribution, because some of that is return of capital, or they're selling stock, or some of it is even short-term gains. So why would you even do that? I mean, you could do that yourself. So guys, let me know what you think about these CEFs. Have you looked into them? Do you own some of them? And do you understand how they work and where your distributions are really coming from? And if you look at the charts of these things, they really don't go anywhere, or they're usually heading lower. So basically, like I said, it's a little bit like a reverse mortgage. You're giving them your house and they're giving you some money every month, because if you look at the stock price, most of them trend a lot lower. So basically, a lot of the money that they're giving you is the money that you paid for these shares in the first place. Remember, the more complicated something is, it's not for your benefit, it's for their benefit. So if it is very hard to understand, it's usually because they are benefiting from it more than you are. So keep it simple and keep more money in your pocket. I hope you like this one, guys. I'll see you in the next one. Thanks for watching.